Good morning, good afternoon, or good evening, wherever you are in the world. We're happy to be here for another edition of FC Live, and we're joined here today with Stephanie Palmeri, partner at SoftTech, a VC firm, and it's good to be here again. And just an apology for the audio quality today. Our mics aren't working, but I guess we'll just have to project a little loudly, and I guess yell at us if we're not.
Give us feedback if you can't hear us.
Yeah. Cool. All right. So I guess sometimes we do intro, sometimes we just jump into it. I see we have like a big list of questions, so we're just gonna jump right into it.
Awesome.
And if you're in the audience, just a reminder that you can ask us questions. Just post this as comments, and they'll get surfaced up to a screen we have here in the studio, and I will ask Stephanie. So cool. So this is a question from Elizabeth, audience question asking, how much financial know-how do you expect from a startup team? So if you meet a founder, are you expecting a certain level of financial literacy, competency?
That's a good question. I certainly don't expect every one of our founders to have investment banking training or to be able to necessarily build super complex models. A good understanding of how to put together a budget is pretty important. I mean, at the end of the day, as a CEO and a startup founder, your number one responsibility once you've raised money is to not run out of money. So you have to have a fundamental understanding of your business expenses, how to do a basic forecasting, but certainly we're not talking about being able to do super complex models from day one. The more financial literacy, the better. I also know that, frankly, a lot of the plans that I see, they're completely based in fiction. So the ability to forecast the unknown is always a nice challenge for the earliest founders.
So it sounds like maybe not they don't have to have a degree in accounting, but they should know the basics.
Some fluency in Excel is helpful, I would say. The ability to be able to understand how much money you're going to be spending each month as you hire people and to forecast that forward, as well as the ability to understand how much money you need to raise and how long that money is going to last you.
Sure. And I have to imagine, meanwhile, the financials of sorts about the actual business itself might be more meaningful, so key metrics and unit economics and things like that.
Yeah, and I mean, in terms of your basic daily accounting that you do on a monthly and a quarterly and an annual basis, a lot of our startups work with outsourced CFO firms. So while you as a founder need to have basic financial literacy to read those kinds of statements and to understand them, it's likely you'll have some support in creating them as well. At the end of the day, where the rubber hits the road, you are in charge and you having a good grasp on the fundamentals of your business is really important.
Sure. So next question from Sherman. So Sherman would love to get your perspective on relationships with LPs. So for those in the audience who don't know, LPs are the investors in VC funds. So believe it or not, VCs have their own investors, in case you weren't aware, called LPs. And so Sherman's wondering basically what's so you're a partner at SoftTech. What's your relationship with LPs once a company is funded by SoftTech, and how can LPs be helpful to VCs beyond just investing in the funds?
That's a great question. It's also the question VCs think about in terms of how once we put money in, how else we can also be helpful. So we raise money every 2 to 3 years from our limited partners, our LPs. And so our initial interaction with an LP is sharing the performance of our fund. If they're a new LP, helping them get to know us as investors and get to understand our investment thesis, how we plan to spend their money if they do invest over the course of the life of the fund, which for us, our initial investment period is 3 years. And then once an LP commits to the fund, we're keeping them up to date in terms of the new investments we've made, how those investments are performing, as well as a general outlook on the market. What's helpful for us from our LPs? First and foremost, our LPs are not just investors generally in one fund. So our LPs have a good pulse on the performance of other funds, how their investments are performing, what they're thinking about. And so having that market intelligence is really helpful to me as a VC. Second, a lot of times they have great relationships to aspects of business that we may not have. So it could be that an LP is a family office So that's an individual or a family that has a certain amount of capital available to invest in companies. So let's say you're an LP who's a family office in the retail space. If I'm investing in retail, the intel that you can give me on the retail market or the relationships you can help with my founders making in that market can be really helpful. So I think it's very similar. You're another step removed from the startups, but you're still able to kind of tap in through, frankly, your VC investors as an LP to figure out small ways or large ways to be helpful.
Yeah, so it's sort of like from a founder's point of view, you get not only the network of the individual VC that you're working with, the partner you're working with, but also those of the firm and, in fact, perhaps the LPs of the firm as well.
Right. Yeah. Exactly. So there's a lot of relationships there, and it's another level of the network to access.
Cool. So quick transition here. Next question. This is from Justin. Are there actionable or any actionable insights that you can offer a company which is operating in a space that has seen sort of significant failures, and in this case, Justin's citing like HomeJoy. For those who don't know, HomeJoy was like a company that saw immense growth in the home cleaning services market, on-demand cleaning business. So that's just.
Yeah. So if I'm understanding the question correctly, I think, Justin, what you're asking is.
Let me add some. I just saw the second part of this. This is coming, I guess, from a founder who's getting ready to raise a Series A.
Okay.
This is a really good question, actually. That's
great question. Yeah.
Facing what he's calling, quote, emotional hangover from speaking with investors. In other words, since I kind of jumbled the asking of the question, just to re-ask it. Sorry, Justin. What do you do if you're a founder where there's like a notable company or companies that tried something that might be similar, or maybe it's different but it sounds similar to what you're doing, and there's this emotional hangover, as Justin's calling it, or some sort of like rub-off effect onto all of your conversations? How do you deal with that as a founder?
That's a really tough challenge, and as a seed investor, my companies sometimes hit that wall as well. So it's smart that you're asking that, and it's smart that you're preparing for it. The fact of the matter is, if I was an investor, say in HomeJoy, and I have a hangover from doing that kind of investment, I may bring a certain bias to the table in terms of looking at deals in that space, at least for a period of time. Now, over time, I may forget the tequila shot that made me sick, and I may be able to go back to drinking tequila again, and then sometimes I just can't do tequila again. And the fact of the matter is, that's true for investors, right? And so part of it is understanding the bias that the investor is bringing into the investment. And so if you're meeting with investors that have a clear bias against doing something in the space, you have to balance out, okay, I have this meeting and I can progress the conversation forward, but is it really going to materialize, and is this the best use of my time? So that's one. The second thing is to take a look at your business and ask, like, what are the fundamental things that are different about what you're building? And if you do butt up against a lot of no's in a market where it's pretty clear you're not going to be able to raise capital, at least through the traditional channels, then my advice is to try to take a step back before you're absolutely going to run out of money and think, what can I change about the business? Now, is there an opportunity to leverage the technology, perhaps target it to a different market? There could be an opportunity to say, we're going to change our go-to-market strategy. I've had some companies be very successful doing that in the past, companies that have started off on a B2C route and really realized that the B2C market was something that A, wasn't attractive enough to investors, and B, would be a really hard business to grow unless they had massive capital in the beginning, and shifted to a successful B2B model. And so there are things that you can look at in your business and ask, are there economic things that we can fundamentally change that will make this more attractive, and potentially that can increase our runway, so that when we do go out to tell a story, not only are we maybe not doing the exact same thing that a fallen competitor has done, but we actually have a lot of traction and proof points behind us. If you're 3 months out of cash, my advice is to try to figure out, if you don't find a natural source of funding, is to try to figure out what would be a good home for you and your team, and to look into the acqui-hire option.
Right, and just because this is somewhat close to home, we weren't investors in HomeJoy, but I know Adora, and I think the thing, she's a great entrepreneur, a great now partner at Y Combinator, and I think one thing to recognize too about a lot of the best startup investors is we all go into this knowing, like, yeah, guess what? Like, things aren't 100%
No.
of great companies are not going to be successful in the end, and you learn. And I think the takeaway from what Stephanie was saying is, like, ideally you adjust, right? And so, like, if there are those notable failures, to some extent that's actually a positive. You can learn from those past mistakes. And so
Something else to add to that about failure too that I think is really important to mention is, if you fail, but you've tried really hard and you've done a really good job keeping all of your investors in the loop, assuming you've raised some money, and you've done the right thing by your investors and by your team and by your customers, that's not necessarily looked at as a bad thing. So, in SoftTech's history, we've backed plenty of founders that have not necessarily had their first company work out, and we've backed plenty of founders that haven't had their first company worked out, and we've come back to back them again. And so you learn a lot about someone's character going through not only the good times, but also the bad times.
That's a good point, yeah. Okay, so next question. This is from Niels, sorry if I'm mispronouncing your name. So this is, I guess, another entrepreneur. We're setting up a company trying to reach the next evolution of real estate.
Okay.
And so my question, or Niels' question is, what is your opinion of the Zillows of this world? And do you think that they're better than just sort of yellow page portals? And are they like the next generation, or do you think that there's like a chance to actually disrupt them? Like, do you actually see an opportunity? And I realize that's a very particular question, but it's from an entrepreneur who's curious about that.
Great. So it sounds like you're doing something obviously in real estate. I think the question that I would think about as an investor, and I would encourage founders to think about. So you're entering a space where there's already some fairly large, call them the new players. So obviously you've got the Yellow Pages of the world, right? You've got the historic, the Craigslist of the world in some cases. And then, you've got an incumbent in the market that's a startup, that's an older startup. And so, maybe they'll continue to innovate a lot. Maybe as a public company, there's less opportunity to do that. I think first and foremost, it's a big market, right? So you want to make sure you're operating in a large enough market that can sustain some degree of competition, and we know that real estate's a very large market, so that works for you. The second thing is, are you building a direct competitor and something where, by sheer volume of, the footprint that Zillow has and the budgets that Zillow has, you to build that new footprint is going to be, incredibly challenging, difficult? Or is there a wedge into the real estate market that you're attacking that's a little bit different and hasn't been done before, and perhaps allows you to take some of their market share over time, or maybe allows you to coexist with them? So I think because there's a Zillow in the market, or because there's a Amazon in the market, doesn't mean that there's not an opportunity to start a startup where you've got a big competitor, but you do have to ask yourself, am I going head to head directly, or is there something unique about what I'm offering that allows me to grow in a way where I can attract additional capital too?
Oh yeah, oftentimes it's like Google was not the first search engine.
Nope.
Facebook was not the first social network, et cetera. Right? So
Yeah.
Usually incumbents are indicative of a large market, like we were talking. Okay, so next question from this is from Summit. By the way, guys, appreciate the questions. Please keep asking, and you're making my job super easy. So Summit's asking, which public technology companies, so public being the keyword here, since we're normally VCs invest in private companies and startups specifically, which public technology companies are you most excited about? And then related to that, what large public companies like the Amazons, Facebooks, Googles, et cetera, do you believe to have the most durable economic moat over the next 5 to 10 years, or the most defensibility over the next 5 to 10 years?
Interesting question. So, I typically am investing in companies with 2 people raising about $1 million or $2 million. So I don't spend a ton of time myself on the public markets. I think I'm really fascinated by what Amazon's doing in voice right now. For me, I think certainly between what Amazon's doing in voice and certainly Google's got with Google Home, I see voice as being one of the next big platforms. And I'm going to be personally spending a lot of time at the earliest stages looking at how companies are going to leverage voice and potentially some of the technologies from these larger companies to build companies on top of those. So, I think that Amazon's kind of building quite an interesting footprint in the home, and I think that that's probably one of the most exciting companies out there right now for me, from my perspective.
Okay. Actually, just a quick follow-up personally question on that. So, do you think that so you mentioned Google Home and you mentioned Amazon, like Alexa, and so forth. Do you think that the competitive edge there, the entity that will be ultimately successful, is it more a function of adoption, meaning, for example, having Alexa embedded in every type of toaster and a
water bottle?
Or is it a function of AI, natural language processing, machine learning, and just being able to like better converse? In other words, is this about being universal and everywhere, or is it about like the quality of the interactions?
That's a good
Maybe
question.
it's about both.
I think it's a little bit about both, right? I think you have to believe that the more interactions are out there, the better the quality becomes. So certainly, having a big footprint is really important. One of the things I think that's interesting about Alexa is just how mainstream it's become in such a short amount of time, and it's almost a natural behavior that consumers know in their home, and you begin to think like, how many more places can we start to have? If we know the lowest common denominator interactions, and over time, the recognition becomes smarter and smarter and smarter, we can do more with it. But even just the portability of my voice in different places is with small interactions, I think is really interesting. I think it's about footprint though.
Okay.
Yeah.
Cool. Okay, so from Michael, audience member, we're doing proof of concept science research, which could be a company in the future.
Okay.
Any ideas on how we can find research funding for a scientific pilot? I have ideas, by the way, because I actually started a company at the lab, but I'll let you
Maybe you should do this one. I mean, I know that if you're at a university, obviously, like sometimes universities have some sort of funding through like tech transfer offices, but again, that tends to not necessarily be for research funding. A little outside my wheelhouse. How did you do it? Let's turn the tables.
Yeah. So quick, brief history note. I started a company out of a university basement, basically, and spun it out, got it VC backed, and sold it. And in that company, in the early days, we actually raised millions of dollars, actually, not from VCs.
Yep.
We actually raised millions of dollars from research funding sources, grants, right? And so specifically, there's something called SBI. If you're a US-based entrepreneur or scientist, there's something called SBIR grants, and you have to be careful not to become, if your ambition is to build a company, it's focused on a specific problem, you don't want to become like an SBIR company that all you do are these SBIR grants. It really has to be aligning those grants with ultimately what you want to build. But if you can do that, it's a great way to get free capital to do the early validation, moving the needle, getting, de-risking the technology risk, right? There's technology risk, business risk, capitalization risk, team risk. There's all these risks. If you can de-risk the technology risk without diluting yourself, without raising capital or having to spend time going to the VC market for that, that's a great thing. And so to some extent, while you hear a lot of buzz about like how awesome it is to be a software founder, like what I'm assuming you're a hard sciences entrepreneur, you have certain benefits as well, one of which is access to quite a lot of free government funding, at least in the United States. And I do actually think there's similar programs in Europe and in Asia, for example.
And likely in Canada too, I'd imagine.
Yes. And then just echoing what Stephanie said as well, there's also a lot of university programs and similar programs that may also offer grant financing, to the extent also that your technology can align with the philanthropic efforts of certain endowments and foundations as well. That can also be another source as well. And I believe, for example, our company took advantage of all of those.
Yeah, I have some companies in the education space that obviously take advantage of some opportunities through things like Gates Foundation as well. So depending on the sector that you're going after as well, there may be other private institutions that can fund things through grants.
Okay, cool. So we'll try to get in just a few more questions. I'm sorry to the audience, as we have a long list of questions, and I guess we're 20 minutes into this, but this is great. Maybe
well, it means that they can probably understand us. They can hear us.
I guess you can hear us. So again, I'm sorry about I'm wearing, this is like a prop mic at this point. It's not actually doing anything, but thanks for being engaged, guys. So this is a question from Alexander. Hello, other Alex. What is the best strategy, or what advice would you offer for a startup based in Brazil to raise funding in the U.S.? And then maybe just to add some element to this as well. The founder didn't specify this, but I'm assuming they're based in Brazil but addressing a global market.
Yeah, so first and foremost, it's identifying investors that actually have an investment thesis for investing in foreign markets. Ideally in your market, but just in general that have a thesis and a mandate that allow them to do that. So for example, at SoftTech, we limit our geography to the US and Canada. And even within the US, we limit our geographies to a handful of tech hubs in the country, surely because we invest early and we want to give hands-on attention. So I would be looking specifically at Brazilian companies, assuming you're going to stay in Brazil. I'd be looking at Brazilian startups and trying to figure out where their sources of capital have come from and identify firms that have shown a proclivity towards investing from the US into Brazil. So that's really a good starting point. I'm sure Crunchbase is probably a really good resource for something like that. Potentially AngelList may be able to help you unearth some of that information as well. So it really is about understanding that the firm has the right dynamics to do it. And maybe they don't have to have invested in Brazil per se, but they have to have generally a history of investing outside the US and ideally in emerging markets in order to kind of believe that an investor is going to make that leap.
All right, question from Sean. So this is a question about how SoftTech evaluates opportunities. So what factors does SoftTech look at while investing at the seed stage? And how do those factors compare or change for a Series A or Series B investor?
That's a great question. So at SoftTech, we have this thing called the 3 S's rule. I don't know if you know about this. So we say at SoftTech that we're investing in smart-ass founders, building kick-ass products in big-ass markets. At the seed stage, and frankly, throughout the life cycle of the company, the founders and then eventually the executive team running the company are incredibly vital to a startup working out. But at the very earliest stages, I have to have the conviction that you, the founder, have the ability to, almost walk through walls and have the vision to see something from the earliest stages to something that can be a $1 billion business one day. And so, and the ability, ideally, to recruit a team, to execute on that vision, and to inspire others to kind of join, whether it's by coming on board and working at the company, or whether it's raising capital. So, team is really, really important. And when I think about the deals that I've done most recently, the founders have a really unique perspective on the space that they're going after. From a product standpoint at SoftTech, we generally are looking for some form of product in the market. It may be as early as a prototype with a little bit of feedback from some early beta customers, or it may be fully blown, some degree of revenue. Generally not a lot of revenue, but some early initial people paying to use your product. So there's a spectrum there. As you move into Series A and Series B, I would imagine the product is launched in the market. There's actually some real revenue traction there. The final piece is the market size. We like to look for a market opportunity that we believe could yield a big $1 billion company. So we're asking ourselves, what does it take for a company to get to $100 million in revenue? Are they operating in a market that's at least a $1 billion market? Which means that to get to $100 million in revenue, you've got to capture 10% of the market. A lot harder to capture 100% of the market. So we want to see companies raising in a big enough market. Interestingly enough, if you look at some of our investments, we're investing in some frontier technologies at SoftTech, and those may be very nascent markets where, when we invested in Fitbit years ago, the wearable market didn't necessarily exist as a market. So you're making a bet on a future market, as opposed to, the great question we had about Zillow and the real estate market earlier. There you can actually do some real sizing. You can find out, what's the commercial real estate or the residential real estate market in the US on an annualized basis and how much it's growing. So we do think about that market size, but ultimately at the end of the day, it's the founders that we're backing. And I think the founders continue to be, the people going out to the market, raising money and inspiring investors to put money in. So really, it's about the founders.
So this is going to have to be our last question.
Okay.
And apologies to the folks that we couldn't squeeze in. We're actually at 5 minutes over as it is, but I really wanted to get as many questions in as I could. And this is almost like a good way to transition or segue from what the last question was about. So this is from Michal. asking, are there, so, and just some quick context, like you've been on the boards of a number of successful companies, I think most recently like Charity getting
Yep.
acquired by Ford, for example, and before that, a company acquired by Twitter, and so you've seen what success can look like. Are there any similarities or patterns that you've noticed between the most successful startups that you've invested in so far, for example, education, background, anything like that that seems to correlate?
Yeah, I think it's interesting. I think there's always this stereotype of like, there's these 5 schools with an engineering background and, a white dude wearing a hoodie. And I think we perpetuate that stereotype an awful lot in Silicon Valley. And if I look at a lot of the founders I've backed, they don't actually fit that mold. For me, one of the most important traits I see in founders is grit and perseverance. It's this ability to have gotten around some form of hardship or difficulty and continue to stick it out and will deal with the grind. And I can tell you that even for the most successful companies that I've worked with, there's still been moments where at any given time things could just blow up. And the founder's ability to kind of get through the difficult times as an individual and then to inspire a team through that and potentially to continue to inspire investors through that is actually probably the one common trait of the folks that I think are most successful. And that has nothing to do with the color of your skin, your gender, where you went to school. That's an innate quality that any great founder can offer.
It's very insightful, yeah. So grit, perseverance,
Yeah.
being relentless. Cool. It's actually a good way to end. So for everyone out there, thank you so much for tuning in, and thank you again,
Thanks for having me.
Stephanie. This is great.
Thank you.
Love the answers, and of course love the questions. So until next time, guys.